Valens Research, Uniform Financial Analytics.
What you're seeing here when we come in, as we just brought up Costco, right, the wholesale retailing company, is our performance and valuation prime chart, right? And so what is this? What does this mean? Our PVP, it's where every single company always starts. Whenever anybody comes to the Valens Research app, you always start with this page. Why? Because this is the bedrock of understanding, one, the importance of uniform accounting, and two, whether a company is undervalued or overvalued. We call it the performance and valuation prime. Why? We're very literally here at Valens, because the fact that we're talking about the performance of a company and its valuations. Performance in terms of ROA, or return on assets, and asset growth, right? How profitable the business is and how fast it's reinvesting in itself. And valuations in terms of our valued asset prime, which is a price to book metric, and VE prime, which is our valued at earnings prime, which is basically a cleaned up PE metric. So when you're looking here, what you can see is you consistently see these orange and blue bars. The orange bars for each of these charts are the orange distorted as reported metrics for the company. The blue bars are the uniform accounting true blue performance of this business. And for Costco, right, what we can see is already the orange versus blue bars. We can see a huge dislocation on an as reported basis. You think that Costco is around an 8% ROA business, which is good, not great, but it's good, right? In reality, this company's profitability is over 2 times that. It's actually at 16%. And as importantly, this company's return hasn't been basically flat over the last 10 years. It's risen from 10% to 16%. This company, if you're looking at as reported metrics, you think you're seeing a middling company with stagnant returns. In reality, you're seeing a company that has strong returns that are improving, right? Literally, you're getting different insights, wrong insights using the as reported metrics than if we're using the uniform accounting insights. And it doesn't stop there. We can also look when we look at asset growth, right? The orange distorted as reported asset growth for this company says that Costco has been investing a lot more into its business in an unproductive way. Well, the uniform accounting says, no, it's investing. It's regularly investing 5+% a year. However, that's been more productive as ROAs have expanded. Again, you have a different level of conclusions and questions you're going to ask management, conversations with your investment committee members when you're looking at the right data. Those two charts, which are really about performance, help us get a better understanding of things like free cash flow, right? Free cash flow is really how much cash does a company throw off after it's finished investing. And so for Costco, what we can really think about is for every $100 of assets this business has, it throws off $16 in operating cash flow, and it's putting $5 back in the business. Free cash flow is around 11% or 11 cents on the dollar, which is pretty healthy, a way that you wouldn't be able to talk using as reported metrics. But it's not just about a company's historic profitability. If you want to understand if a company's undervalued or overvalued, you need to understand what the company's trading at, what valuations are, and what the market's pricing in. And that's when we come down to the valued asset prime ratio and the valued earnings prime ratio, right? Valued asset prime, the orange bar is the orange distorted as reported price to book for this business. The blue bar is the uniform accounting, true blue, real valuations relative to assets. What we can see here is, right, this company is not as expensive as reported metrics reflect. Similarly, we can look at a as reported distorted PE for the business and the uniform accounting PE for the business. What you can see is here, actually, the as reported PE is for the most part tracked what the uniform accounting one shows us. And right, the idea here is for this, we're looking at, is the market paying for growth, et cetera, like we would a traditional PE, we can compare it to peers, et cetera. This last chart here is TSR, right? TSR, for those of you who don't know, is total shareholder return, right? It's the combined stock appreciation dividend income that a company generated for its investors each year. The second R here, the small r, is relative. Relative to what? Relative to the index for the company that's relevant. Since this company is a US company, relative to the S&P 500. When this line is flat, that means that the company's stock performed in line with the market. When it rises, it means the company outperformed the market. What you can see, which is super powerful, is there is a very strong relationship between this blue line and the uniform accounting analysis in a way that there isn't when we look at the as-reported analysis. But on an as-reported basis, this company's returns have been basically flat the last 15 years, and yet the TSR, right, it has outperformed the market 4 times. The market's been up 100%, it's been up 400%. Why? Because the market's really paying attention to the uniform accounting true blue ROAs that have expanded massively while the company's been able to grow. Right? You can see time and again when we look at these charts, this TSR relative to the market shows you the market's clearly paying attention to the uniform accounting analysis. But all that is not about whether or not a company is undervalued and overvalued. That's where these last bars come in here. And right, that's a really powerful conversation that we can have with uniform accounting. It's not just understanding that you are missing the picture if you're looking at as reported metrics. It's also about understanding what the market's priced in. These two light blue bars are what Wall Street analysts are forecasting Costco to do for the next 2 years based on us taking their consensus estimates and pushing it through the uniform accounting framework. These white bars, they're what the market is pricing Costco to do at a $160 billion market cap or $360 stock price. Basically, for Costco to be fairly valued, over the next 5 years, it needs to see returns expand from 16% to 20%, and for asset growth to continue to be around 5% a year. If you think that Costco can do better than that, Costco's undervalued. If you think Costco can't do that, Costco's overvalued. It's that simple, right? We basically are just using these to really set the line and say, what does the market think? And based on what the market thinks, now I don't have to do all the research as to whether or not I think this company is overvalued or overvalued. I can start with the better art to say, do I disagree with the market? Because if I don't disagree with the market, if I agree with the market, I don't have to do any other work as an analyst, as a portfolio manager, as an investment firm, because I can clearly say, yeah, I think that Costco has seen returns expand by basically a third in the last couple of years, and all that the market's pricing in for it to expand by a third again and continue to grow at the rate that it has, that makes sense. And I can say, cool, I can walk away. But the other cool thing that we can do is using the Balance Research app, we can quickly do scenario analysis also. So when you're having conversation with your analyst team, with your portfolio management team, when you're thinking yourself about what you think a company can do, you don't have to build your own gigantic DCF. Knowing the right numbers, uniform accounting numbers, you can then basically play scenario analysis. We have what we call the embedded expectation tool here. And you can just toggle this and we can say, you know what? I don't think that the company is going to grow at 5% a year. I think that it can keep on growing at 7% a year. But I still think that it's going to continue to see ROA expand to 25%. And I can say, okay, if I think those things, what does that mean the stock's worth? Right, I can calculate that. This is probably going to say the stock's worth, I don't know, maybe $425, $450. And basically what you're doing is, right, you can basically do the scenario analysis to understand, well, what, based on what I think the company can do, is the company worth? What we'd argue is that the market's probably right with Costco. Quite frankly, normally the market is right, which is why this is so powerful, because it saves you the time of doing work on a company that you'd probably say, yeah, I want to walk away because this makes sense. But let's say that you think that Costco's ROAs are stagnant, right? They're going to basically plateau at these 15% levels. Well, if you think that's the case, right, then the company is worth a lot less. And this is the kind of quick analysis that you can do using the uniform accounting and balance research framework.
Balance Research, the world's leading source for uniform financial analytics.